everybody. Welcome to our second episode of Lender Chat. Today we have Mark Howard, who is a wholesale lender with C2 Lending. Several of my clients have worked with Mark over the last few years, and he's an excellent resource. And Mark is able to explain to me all this rate craziness in simple terms so that it finally clicked and made sense. So I am going to turn this over to Mark. And no, we are not both on a tropical beach. We both just happen to love the beach. So Mark is going to share his screen, and the graphs that he's showing we will have available as downloadable PDFs in case you're interested in the description. So
Awesome.
Mark, make it
Well, thanks so
simple
much,
for
man.
us.
Great chatting with you. I appreciate it. So just for some big picture context, first of all, the question we want to answer is, where do mortgage rates come from? Like, who sets them and how does that happen? Well, first of all, there's not a specific entity or person or bank, and not the government, that sets a specific mortgage rate. It is a moving target from bank to bank, lender to lender. And so let's talk about, where does that number come from and how is it set? Dive in. So first of all, let's talk about investors. If you were an investor, where do you want to put your money? And that's going to lead us to where mortgage rates come from. Okay, so hang with me just for a minute. So let me share my screen.
Well, I can answer that rhetorical question while you're sharing your screen. As an investor, I would want my money where I can make the most and it's safe.
That's exactly right. Perfect. Thank you. Great answer. So here we go. So if you're an investor and you want to park your money somewhere safe, the baseline for investing is the US 10-year Treasury. Can you see that on my screen?
I can.
All right. This is live data from the US Treasury, a 4.291 interest rate. So that's kind of your baseline investment. Very safe 10-year government-backed Treasury. So everything is going to be in light of that. So if you're an investor and you want to make a little more money, but still a fairly safe return, one of the next investments you might choose is a mortgage-backed security. A mortgage-backed security is think of it kind of like a mutual fund of thousands of mortgages that are sold as an investable entity, right? So here's a graph showing the mortgage-backed security rates and the 10-year Treasury rates. So if you're an investor, you want to make maybe 1.5% more on your investment, mortgage-backed security is a great choice. It's still pretty safe. It's based upon thousands of originated loans that are using things like Fannie Mae, Freddie Mac guidelines. So if you follow those guidelines, it should be a safe loan that can be repaid and so forth. A little more risky than a Treasury. So when a Treasury rate goes down, mortgage rates follow suit. And you can see on this graph, almost identically, they follow suit because investors will move their money back and forth. If Treasury rates go down, they're going to put it back into mortgage-backed securities, and mortgage-backed securities goes down, they'll put it back in a 10-year Treasury. So there's always going to be that gap. If there wasn't a gap, why would anybody invest outside of a 10-year Treasury? There's got to be a gap. So that 10-year Treasury line pushes that mortgage-backed security line with it. Now, what is a mortgage-backed security, right? So we understand investors' mindset. What is a mortgage-backed security? So here's just a simple graph to give you an idea of how it works. So John wants to buy his house. John goes to his bank to borrow money for the loan to buy his house. That bank or that mortgage company originates hundreds and thousands of those loans, but that takes up all their cash. They're using their capital to write those loans. They need to get some of that money back so they can originate more loans. So that bank will bundle those mortgages and then sell them to a bigger investment bank, or what we call an aggregate. An aggregate bank isn't necessarily a bank like Chase or Wells Fargo or whatever. It's actually entities like Fannie Mae and Freddie Mac. Fannie and Freddie own, I believe, over 2/3 of conventional mortgages. That's what they do. They buy up these huge bundles, thousands and thousands of mortgages. They put them together and then they sell mortgage-backed securities. It's an investment tool that is based upon those mortgages. So those mortgages are bringing in a monthly income stream of principal and interest. So you have another group over here, which is your investors. Investors could be big investment firms, brokerages, and it can be individuals. Individuals can also invest in mortgage-backed securities through these investment firms. So those investors are getting a monthly return from these mortgage-backed securities that are being sold by large banks or by aggregates like Fannie and Freddie. Okay, so John buys the house, bank bundles them, bank sells them to big banks or to aggregates, and then those are then sold as a mortgage-backed security. Okay, this mortgage-backed security concept is a really big deal. Go ahead, Pam.
Well, I was just going to say, and because it's a pool of mortgages, it's kind of like insurance. You're spreading the risk out over a larger group to minimize the risk.
Exactly. Or like a
right?
mutual fund, right? If you have a stock mutual fund, it's investing in 100 different companies. Some do well, some do poor. So it mitigates the risk.
Right.
Exactly. So that's why an MBS is still a safe investment, but not quite as safe as a 10-year treasury. Okay.
Okay.
So we have this investable commodity right here. Okay. That's investable right there. That commodity goes up and down based upon a lot of different factors. The biggest ones are going to be right now, especially inflation. Inflation goes up or down. That affects mortgage-backed securities. World news and events, war in Ukraine, war in Israel, that can affect the mortgage-backed securities. So the Federal Reserve changing the federal funding rate. Remember, the Federal Reserve changed the federal funding rate, which is the rate at which banks borrow money from each other at an overnight rate.
Okay.
But that federal funding rate can have an impact on the mortgage-backed securities market as well. So just think of this as a portion of the stock market that goes up and down on a minute by minute basis. Okay. And I'll show you that market here in just a minute. Okay. So we have this commodity that can be bought, sold, and traded. So now how does that translate into an actual mortgage rate? Well, here's an example of building an interest rate from November 2024. This is directly from Fannie Mae's website. As a sample, it just happens to be pretty spot on to what we're at right now. Mortgage rates are at around this 6.81 for conventional as well. So here's an example. Let's say that let's say a particular bank wants to decide today's rates. They're going to look at what is the 10-year treasury note? What's that baseline number that investors want to see? So let's say that that's that 4.36 today. And then the second layer here is what does it cost to originate the loan? So your origination fees are going to be everything from your admin and your processing, your commission to your loan officers. If it's a brick and mortar establishment, we got to pay for that. If they've got health benefits, pay for that, right? So the bigger the organization, the more expenses they have, they're going to have maybe a bigger spread, right? Depending on their expense and income ratios and all that. So
Makes
this
sense.
orange spread represents primary to secondary means getting the loan from the little bank to the big bank. This is primary, this is secondary. So the
Okay.
cost of getting from primary to secondary is this additional add-on to the rate. They make up for those expenses by adding on to the rate. That's how they make more money, right? And then the third spread here is the secondary spread. That is from the big bank to the investors. The investors want to make more than it cost, right?
Right.
So there's one more spread here in between these two items. So that's your second set. You add up all these together, you get a 6.81, right? So that's how it works. Now, different banks will have slightly different rates. They want to be competitive. They're watching other banks and things like that. But this primary secondary spread has a lot to do with how much it costs to originate that loan and so forth. So for example, as a wholesale mortgage broker, we have very, very, very low expenses. I don't have brick and mortar. I don't have health benefits to pay for other people and things like that. So we have very cheap expenses that keeps our spread down here in the middle. Retail mortgage companies have much bigger expenses to pay for, and so their rates are a little bit higher. It works its way into the rate. But everybody wants to be competitive. Okay, so what's happening right now with the mortgage-backed securities market? Here's a real-time snapshot of the last couple of months of the mortgage-backed securities market. And what this indicates is the red lines mean that the market traded poorly. Investors didn't like it, didn't want to buy into it or whatever. So it traded poorly that day, that day, that day, that day. This was February, just a week and a half ago. And the mortgage-backed securities market declined, therefore interest rates went up. And then the green is the opposite. This week, mortgage-backed security, the price of mortgage-backed securities, the value of that commodity went up, therefore interest rates came down. Okay, so it's inversely proportionate. Green is good, red is bad. MBS does well, rates go down. MBS does poorly, rates go up.
Okay.
So you can see this track, though, we've basically just kind of crawled our way back to where we were back in December, which is giving us those rates in the middle to high sixes. So that's the mortgage-backed securities market. So on a daily basis, I'm tracking this minute by minute. Where are we at? Today, we're 20 basis points up. That's great. So rates will see a little bit of an improvement today because of that. So I'm tracking this minute by minute to help you decide when to lock your rate. And this is all driven by investors. Okay.
Okay.
Investors are driving the market. Go ahead, Pam.
So this might be a good place to ask the question. All the economists that I follow, that, I've watched their predictions and whatnot for 2025. And what they're saying is that we can pretty much expect for rates to hover around where they are
where they are
now,
now.
maybe a little lower, maybe a little bit higher on some days, but for the most part, in 2025, we are not going to see a dramatic increase or decrease.
Yeah, that's exactly right. And so
Okay.
this 1 year graph of the MBS will kind of help explain that. So what you see here is you see that we had like about a month of September where rates got much, much better. And why did that happen? It was because the Federal Reserve was talking about we're finally where we're at to be able to begin dropping the federal funding rate. And that was really good news for the market. The market
Yeah.
reacted really, really well. It had been rate increase, rate increase, rate increase, and then finally we're going to cut rates, right? So that news cycle through the course of September brought much, much better rates. But then here, what we saw was the inflation data went the other way. Inflation data started showing higher inflation. And so we kind of gave up that ground. This big red bar here, for example, was inflation data that came out in January 10th, right? So the inflation data has kind of hurt us back down. And so if you look at this, more on a bigger 1 year level, you see that we're not too far off from where we were last spring, right? We're pretty close to where we were last spring. So we had that improvement, we had that decline, and we're kind of back where we started. So the Federal Reserve has said that they're not planning on cutting rates much, if at all, this year. And so we just don't see any significant factors that are going to cause a decline in interest rates over the next several months, except for slowly improving inflation. So inflation and other data like that, housing sales and in different news media comes out. If that continues to be positive, then we might see some minor improvement. And I do think we're going to continue seeing minor improvements. So like, for example, we've slowly improved over the past couple of weeks. I think we'll see continued slow improvement and then a little decline and then some slow improvement, little decline. So hopefully we work our way towards a little bit lower rates by the end of the year. So maybe we see, quarter, maybe a 0.5% better by the end of the year, but that might be about as much as we're going to see.
So other things I'm trying to, because I'm not an expert in this at all, which is why I really appreciate your great explanations. I listen for the things that I need to be, paying attention to. Like when the jobs report comes out, that seems to sometimes have, they're talking about, well, the Fed, because of this report, the Fed may do this. And the same thing with the consumer price index. Now, is the consumer price index used interchangeably with inflation?
Yes, CPI is part of the inflation data, correct,
Okay.
right?
Jobs are a part of that. And then I know we've also got a report coming out either this week or next week on housing starts. So that may kind of play
That's
around
right.
with
So
this a little.
all of those are factors. So let me
Okay.
sum it up into one big picture concept that I'm so glad you said that because this is an important big picture concept. When the economy does well, interest rates stay high. Why? When the economy does well, there's demand. There's demand for purchasing and lending. So if I'm making a lot of money, I'm more likely to go buy a car, more likely to go buy a house, I'm more likely to spend money. So there's a
Okay.
greater demand for lending. When there's greater demand, you can get away with higher interest rates, quite frankly. There's just more demand. So when the jobs report says lots of jobs have been created, or conversely, if the unemployment rate is low, that means the economy is doing well. More demand means higher interest rates because there's demand for buying and lending and spending. And then the opposite. So for mortgage rates to come down, really, we want the economy to cool off. We want to see a little bit higher unemployment. We want to see a little bit lower job creation. We want to see lower inflation, less spending and so forth. So that correlation, does that make sense? So good economy means higher rates because there's more demand. Bad economy means lower rates, less demand.
Yeah, because I think the way, because I had asked you specifically about why does the jobs report, how does it affect it? If you've got more employment, so more people are working, you don't need to have the lower rates because if people have jobs, they're able to buy
Exactly.
without the help of the Fed lowering rates. Does that make,
That's
is that
exactly right. No,
okay?
that's exactly right. If you